You're listening to Smart Metals Radio from the Hard Assets Alliance.
Hello, welcome to the show with me, Andy Duncan, in London. Today, coming to us from San Antonio in Texas, my special guest is Frank E. Holmes, who's the CEO and Chief Investment Officer at US Global Investors. On today's show, we'll be discussing the love trade of Western gold moving to Asia, the fear trade of paper money printing, and Frank's view on the outlook for gold and silver over the next 12 months. Hello, Frank.
Hello, Andy.
Now, you said recently that the old fear trade in gold, where people are afraid of price inflation, has been replaced by the love trade, where gold's moving from the west via Switzerland to the east because gold is loved in Asia. Do you think this love trade's going to keep going, or is it going to fade away over the next year or so?
That's a great question, and I think we have to go back to look at the 70s when when the dollar lost its convertibility into gold, and gold started to make a spectacular run to 1980. During that period, it was predominantly a fear trade. It was dominated by negative real interest rates by most of the countries in Europe. They were fighting inflation. If you recall, the UK inflation had run to about 20 some odd percent. And we had this also explosive inflation take place in America. It's different because back then, China and India had no global footprint. Their GDP of the world might have been 2%. Today, you're pushing over 23%, and they're 40% of the world's population, and they are connected, they are wired. There is over 1.2 billion people wired on Facebook. They have their equivalent of a different model in Facebook in China, but nevertheless, they are all wired and they all want a better dream. And that is what is really a significant change, because we are witnessing a rising GDP per capita. And the rising GDP per capita of the Middle East, China, and India has a high correlation to the consumption of gold because of the emotional, cultural affinity of giving gold for various religious and achievements, from graduating from the university to a wedding anniversary to a birthday, you name it, the gold is given as a sustainable gift.
I was actually in Chennai in India last week, and everyone there was on Facebook and had wireless and Wi-Fi, and there were an awful lot of people there. Now, do you think this love trade could combine with the fear trade later in the year? Mr. Volcker back in the 80s managed to kill off the speculation on the dollar by raising interest rates in the US to really high levels. But we have Miss Janet Yellen at the Fed now. Do you think that she could oversee an era of negative real interest rates, which could drive the fear trade again for gold?
Well, I think so, and I think what we saw last year, starting in March, we had negative real interest rates in the U.S., and then by December it went positive. So the 5-year government bond went from minus 50 basis points to a plus 50 basis points, and that was a substantial percentage change that saw the price of gold fall from 1,600 to 1,100. And now since then, until mid-March, we had interest rates go from plus 50 basis points to minus 7. Now they're basically flat. So I think that we're going to see this sort of precarious nature that the governments are basically showing their ineptness in fiscal policies, and they are still on steroids in regulating every component and aspect of society's lives. So who's coming to the rescue right now to try to keep the economy going has been monetary, and monetary policymakers have become significant of keeping the economy afloat, but this can't last forever.
Yeah, now we saw gold go down from $1,900 to the $1,100 mark. It has crept up now to around $1,300, $200 higher today as we speak. When do you think we're going to see $1,900 again to keep all these investors happy who invested at $1,900? Or even when do you think we might get to $2,000?
Well, I think it's a very, very reasonable and questions to ask. And one of the things we were looking at was real GDP. Besides real interest rates, when we look and analyze the fear trade, we try to simplify it to two significant drivers. Real interest rates. What will a government pay you on their short-term government bonds above the inflationary rate, and the growth in or contraction of money supply? And what what we've noticed is that this negative real interest rates is the most significant sensitive factor for driving on gold, off gold in that country's currency. When we take a look at the amount of debt that's out there, any serious rise to interest rates to 6% in the US, it will cost $50 trillion to be able to service and pay off that debt. So I don't really see interest rates rising dramatically, and I don't see any policy changes to say, let's put a cap not on spending, but let's put a cap on rulemaking, that no new regulatory rule in some capacity can be implemented unless something's taken away. So in that context, this sort of fear trade, what will drive that is will be this continuously printing of money and trying to stimulate it. But then what has happened for the past 3 years for your listeners is that we have witnessed global GDP peak in 2010. And it peaked at 5.4%. And a lot of that came from the huge injection of money by China to stimulate their economy, and also America's spending $700 billion of fiscal stimulus in addition to monetary stimulus. Well, since that date of the peak of 2010, we have witnessed the global economy contract at 3%. When we take a look at the end of 2013, we've now started to see a rise, and thank God the U.S. had a strong economic engine last year, because the global growth would have probably fallen to 2.5% in real terms. That affects the love trade. And what is forecast going to next year is, in the next 6 months, is a rise in global GDP to about 3.5% from the 3% level. And I think that is a key catalyst to seeing where you get that other demand from the love trade taking place.
And do you think in the West we'll actually start running out of gold? Do you think all the central banks which are leasing this gold to the East are actually going to start running out?
You know, it's a great question. There's been a scramble to get the gold. The biggest physical trophy has been in Venezuela. And if you go back and take a look at when gold ran to 1900, there was 3 factors that were taking place, clustering like the stars were aligned. One was the fear trade of U.S. having the currency devalued and Obama fighting for the debt ceiling. And also it was the beginning of Ramadan, a huge religious giving in the Middle East and India for gold giving. And you had Venezuela having the huge physical delivery of its gold back to Venezuela. Now, what recently happened is that Goldman Sachs was able to borrow that gold, and so that could basically give a physical dampening of gold short term. But I think it's just a matter of time that this gold gets absorbed by Asia and by other prosperous and smart central banks that are recognizing having gold as a foreign reserve.
Now, if the Federal Reserve monetizes even a fraction of the 50 trillion that you mentioned, there should be a huge rise in the price of gold. Now, as an insurance policy, and I know fund managers dislike giving out general advice, what's the minimum amount of gold you think somebody should have in a typical portfolio?
Well, I've been very strong on this. I've written about it, and I'm just very firm in feeling comfortable that investors consider a 5% weighting in bullion, gold coins, estate gold jewelry, wear your gold, and the other 5% in gold stocks. And that's a total of a 10% weighting. And what you do is you rebalance that each year.
And how do you see silver in this equation? Do you think it's too volatile? Now, gold's volatile against the paper dollar, but do you think silver's even more volatile and too volatile for investment purposes?
No, you know what? I think it's one of the best gifts to give out. It's better to give a grandchild and a child a silver coin than it is a silver eagle than buying them, let them go buy a video game. A video game will expire in its usage, but that silver coin stays with them for the rest of their life. So I have a vault. Every Christmas, I gave all my employees a silver coin, and I've been doing it now for 2 decades.
Now, some people say that silver's price at $20 approximately at the moment is a spectacularly high value kind of price. Now, back in the 80s, again, we had the Hunt brothers going towards the $50 mark. Do you think silver could hit $50 within the next couple of years, or are we still a decade or so away from the magic $50 for silver? You
know, what took place with the Hunts was a very much a bubble, because It was exceedingly leveraged. It was a leveraged game. The futures market for gold and the futures market for silver is what jammed those prices. This is a different environment. Much of the consumption of gold is cash, and if it's margin on the ETF, it's 2 to 1. It's not 10 to 1, or some people like the Hunts were leveraged 20 to 1. I think that silver also is a very important commodity metal for the industry, for basic industry. And you're seeing in hospitals and healthcare, et cetera, that it's used much, much more. And so I could easily see silver go back to $50 an ounce easily.
Okay, and silver's used a lot, of course, in antimicrobial things, isn't it, for clothing and also in solar power. Now, moving on to things like power, in the energy markets, we've seen a big growth in the last year, beating the S&P, I think, year to date by about 3%. Do you think this trend for energy is going to go up in this real resource sector, or is it going to cycle down again if economies start faltering?
No, I think the energy is a very key component. Any rise in global GDP, just think that oil prices are hovering around $100 a barrel, and real global GDP has been falling for 3 years. What happens when global GDP goes back to 5%? What happens to the price of oil? It trades higher. And America is in such a great position because of its natural gas, and its oil prices are less, so therefore it can make refined products. So one of the key factors is look at refineries in America in the past year. They were up 50 or 60% 2 years in a row. It's like biotechnology companies. Chemical companies have been on a tear. Why? Because their input is natural gas, and therefore they have huge profit margin because they're able to export a final product which emerging countries are using. Albania exports its oil and then has to turn around and buy refined products to run their car vehicles and trucks on. So I think that the energy demand can easily see oil at $120, $140 a barrel. Over the next 5 years. I think very comfortable. And if you take a look at non-OPEC countries and the contribution from OPEC countries, they're at maximum capacity right now.
Before we go then, Frank, along with John Katz in 2008, you wrote Gold Watcher, Demystifying Gold Investing. Are you going to plan any new edition of this book, or do you think the lessons in that book still hold true today?
I think the lessons are very similar. I think the only difference really when I was trying to explain investing in gold is that gold stocks, that there's many more delays and disappointments because of the bureaucracy of governments and NGOs. There are two types of NGOs, and many of them are not good organizations that are out there just to be disruptive in society and for poor areas. I saw in Albania that what was a disaster 10 years ago for oil fields, after you saw American and Canadian ingenuity and great engineers coming from Calgary go in there, it's spotlessly clean. It's producing, Bankers is producing $300 million of cash flow. They've cleaned up the countryside. There's sheep running around. Everything's green. So I think that it's important that investors recognize that the process that used to take 1 year is now 2 years. What used to take 2 years is now 4 years. So that's the only thing on that life cycle of a mine that is key. We're seeing now many big takeovers, looking to streamline organizations, and we're seeing a flight to capital back from many of these emerging countries, such as the whole drama with a Cisco and Goldcorp and Agnico Eagle and Yamana. Money coming from basically a Canadian sovereign fund, money staying the money to stay in Canada, because so many millions and hundreds of millions of dollars have been destroyed by governments changing the goalposts in Latin America or Africa. So that risk is so high. So you're going to see a lot of those projects in those countries not get developed. That will shrink the supply, and you're going to see money flow back into Canada. And so that still is going to delay the process of this supply coming on. And that's the only real addition I would add to that book.
Okay. Well, it's been fascinating speaking with you today, Frank. What's the best way for our listeners to find out more about you and US global investors?
Log on to usfunds.com. I have an investor alert that is written by my investment team that gets out every Friday night that does what's called a game film analysis, SWOT analysis. And it's simple, it's comprehensive but concise. It's 12 sentences, 3 strengths of last week, 3 weaknesses of last week, and what do we perceive could be 3 opportunities next week for the gold markets or 3 threats. So you can log on to feel and understand what the gold fund managers and myself are seeing as we travel around the world. I have about 40,000 readers in 170 countries.
And I love reading simple research reports. Thank you very much for your time today, Frank E. Holmes.
Thank you, and happy investing.
Subscribe to the Smart Metals Radio Show on iTunes. You can also visit us online at hardassets.com/radio, where you can subscribe to our free mailing list and receive our free Smart Metals newsletter. For anyone who wants to set up an account with the Hard Assets Alliance as a special offer, we shall be waiving opening and setting up fees. Listeners who'd like to speak to a live rep to walk through the registration process can call 1-877-727-7387. That's 1-877-727-7387. I'd just like to thank Frank E. Holmes for joining us on today's show, and I'd like to thank you too for listening. Until next time, goodbye.